For most people, retirement is framed as an age, a finish line you cross at 65, when the social safety net turns on. But the actual physics of retirement are much more precise. Financial independence is a mathematical threshold. It's the exact point where the income from your assets covers your annual expenses, making your daily labor optional. This chart shows how that threshold is calculated using the 4% rule. To retire safely, you need approximately 25 times your annual expenses invested. If your life costs $40,000 a year, your target is $1 million. If you need $80,000, that target moves to $2 million. This curve demonstrates why the timeline is more impactful than the starting salary. To reach a $1 million goal by age 65, a person who starts at 25 needs to save about $700 a month. If they wait until 45, that monthly requirement jumps to over $3,000. The compounding math does the heavy lifting, provided it has enough decades to work. But to leverage that math, we must be honest about passive income. It is often sold as a zero-effort hack or an overnight shortcut. In reality, while the income arrives without your ongoing involvement, it is almost never born that way. Retirement is an engineered state. It is achieved by the deliberate construction of income-generating assets that eventually fund your life without requiring your labor. Every sustainable income stream starts with a massive input of effort. You either commit a significant upfront investment of capital that you earned through years of disciplined work, or you commit a significant upfront investment of time and skill. This is the creation phase. The person collecting dividends today spent decades saving. The person collecting rent today spent months finding and fixing a property. The passive maintenance phase only begins after the initial engine is fully built. Most Americans who successfully bridge this gap rely on 4 primary engines: investment portfolios, real estate, fixed income, and business systems. We are going to run an ROI analysis on each one, evaluating the exact input required, the expected yield, the hidden trade-offs, and how the tax code treats the final result. The engine you choose depends on your current resources. You are either sitting on a surplus of investment capital, or you have a surplus of time to build assets from scratch. Engine 1 is the investment portfolio. The input is simple but demanding: decades of automated, disciplined contributions into low-cost index funds, capturing every employer 401k match and maximizing Roth IRA limits. This matrix shows the trade. You provide high capital input over a long horizon, and in return, the portfolio supports a sustainable 4% annual withdrawal rate. Once the assets are in place, the ongoing management effort is the lowest of any engine. As the highlight shows, the tax treatment is a major advantage. If you hold qualified dividends and long-term gains in a taxable account, a married couple can receive up to $89,000 in annual income and pay 0% in federal taxes on those gains. The hidden trade-off is psychological. You have to be capable of watching your net worth drop by 30% in a single year without selling. If you panic during a bear market, the engine fails. Investment portfolios are the least active way to retire, but they require the longest time horizon to fully mature. Engine 2 is real estate. The primary input is a 20% down payment, but it also requires an active time commitment to find properties, to vet tenants, and manage ongoing maintenance. The outcome is driven by leverage. You use a small amount of cash to control a much larger asset. Over time, the tenant's rent covers the mortgage and expenses, while the property appreciates, eventually leaving you with a paid-off, income-generating asset. This matrix row highlights the tax benefit: depreciation. The IRS allows you to write off the value of the building over 27.5 years. This paper loss can offset your actual cash rental income, often resulting in a tax bill of $0, despite having cash in your pocket. The trade-off is illiquidity and concentration risk. Unlike a stock portfolio, you cannot sell 10% of a house for quick cash, and a single bad tenant or a major roof failure can wipe out your entire year of profit. Real estate accelerates wealth through leverage, but it functions more like a part-time job than a truly passive investment. Engine 3 is fixed income. This involves buying debt instruments like treasury bonds or corporate bonds to create a bond ladder, a staggered series of investments that pay out regular interest at predictable intervals. This engine protects you from sequence of returns risk. If the stock market crashes right as you retire, having 2 years of living expenses in bonds prevents you from being forced to sell your stocks at depressed prices to pay your bills. Social Security is the most common form of this income, By delaying your claim from age 67 to 70, you receive a guaranteed 8% annual increase in your benefit. For a retiree with a $2,000 benefit, that delay adds nearly $500 a month for life. The trade-off is that bonds and Social Security have limited growth potential. Because the payments are often fixed, their actual purchasing power can be eroded by inflation over a 30-year retirement. These vehicles are not designed for aggressive wealth creation. Their role is to provide a reliable, government-backed baseline of income that covers your non-negotiable expenses, regardless of what the stock market does. Engine 4 is sweat equity, building lifestyle businesses, creating intellectual property, or launching online platforms that generate royalties and advertising revenue. This requires an intense upfront investment of time to design automated operations. Once the content is created or the business systems are documented, the machine can generate income with only occasional maintenance from you. The outcome is a scalable yield that is uncorrelated to the stock market. A successful YouTube channel or a niche software product provides a diversification benefit that traditional investments cannot match. But this path has the highest failure rate. It can take years of consistent effort to see any revenue at all, and the digital landscape changes so fast that your income can decay if you stop updating the system. Business income is the primary path for those who lack starting capital. It allows you to convert specialized skills and high-intensity labor into a high-yielding asset without needing a bankroll to get started. Success depends on the order in which you build these engines. Every dollar you have is a finite resource. If you try to fund a down payment, maximize a 401k, and pay for business startup costs simultaneously, you will likely run out of capital before any single engine is self-sustaining. This flowchart shows the necessary sequence. Step 1 is capturing your employer's 401k match and maximizing tax-advantaged accounts. This bedrock provides an immediate, guaranteed return. Step 2 is where you branch. If you have time and an appetite for debt, move into real estate for leverage. If time poor, direct your surplus into a taxable dividend brokerage. Focus your capital there until the income becomes meaningful. Step 3 happens as you approach retirement. You shift focus to risk management, building bond ladders and optimizing Social Security to protect what you've built. Proper sequencing ensures that your most volatile and high-effort engines are always supported by a stable, automated foundation of index funds. To find your path, look at your profile. If you are a high-income professional with no free time, avoid the trap of active landlording. Stick to automated tax-advantaged accounts and REITs. Your goal is to use your high salary to buy back your time as efficiently as possible. If you have minimal capital, you have to build your equity manually. You invest your personal time into house hacking or building a business. You are essentially trading your current labor for a future income stream because you don't yet have the cash to buy one. If you are already within a few years of retiring, your focus must be on the safety floor. At this stage, your priority is no longer making more money, but ensuring the money you have is protected from a poorly timed market crash. The Americans who actually retire on passive income are not lucky. They are ordinary earners, teachers, engineers, and small business owners who remained patient and disciplined over 20 or 30 years. Retirement is not a vague aspiration. It is a solvable equation. Once you define your expenses, pick your specific engines, and follow the sequence, you can stop trading your life for a paycheck and start living on the systems you've engineered.